Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip drills into the fourth quarter FDIC Quarterly Banking Profile to identify potential bank failures. I have been warning about bank failures for almost 2 years through my unique analysis of FDIC data, particularly covering community and regional banks overexposed to construction and development loans. At the end of 2007, there were 8,533 FDIC-insured financial institutions, and I estimate that only about 1,205 are publicly traded. Of these, 467 are overexposed to construction and development loans. The regulators have been worried about this overexposure versus risk-based capital since the fall of 2005. The regulatory guideline is 100%, and these 467 are above that warning line. The aggregate ratio for the problem 460 is 185%, and the dollar commitment of C&D loans is $204 billion out of a total of $629 billion for the entire industry. Over the past week, I showed this FDIC table, which shows the building wall of 2,368 banks overexposed to construction lending. Many of my problem 467 banks are likely bricks in the wall. My second blip describes the dilemma banks face in managing exposures to C&D loans. The regulators want home builders to stop building until the inventory overhang is worked off. The problem with this idea is what becomes of the $629 billion already lent to home builders and other developers. As construction projects stall, C&D loans become non-current, and this risks another wave of write-downs. We already know that home builders are keeping their shovels and hammers quiet, trying to sell homes one at a time, and the aggregate disbursement among the problem 467 is 71.9%. The normal pipeline is 60%, so collections have slowed. Banks may have decided to keep loans non-current in hopes of a second half 2008 housing recovery. Banks do not want to become the owners of last resort with assets shifting to that dreaded category called OREO, other real estate owns. This doubled to $12.1 billion in 2007. I am not confident of an early housing recovery and predict that non-performance of C&D loans will be headline news later this year and into 2009. My third blip profiles 2 regional banks that made it onto my problem 467 list. BB&T Bank, with $128 billion in assets, continues to increase their exposure to C&D loans to $19.5 billion from $19.2 billion in Q4 2007. These loans are 85.8% dispersed, so their issue is collection. BB&T has a ratio of 182% of risk-based capital. The daily chart shows a trading range between 26 and 37. Regions banks with $137 billion in assets decreased their exposure to C&D loans slightly to $15.5 billion from $15.7 billion. These loans are 56% dispersed, so they have slowed disbursements. Regions has a C&D ratio of 122% and is a trading range between 18 and the 27 to 29 area on its daily chart. My fourth blip profiles American Communities Banking Index, ACBQ. The ACBQ is a market-weighted basket of more than 500 smaller publicly traded FDIC-insured financial institutions. Some of these banks are on the problem 467 list and overexposed to construction and development loans. The year-to-date low is 203.12, with the 50-day simple moving average at 228.43, and the February 1st high at 245.55. Join Traders Club this evening at 6 p.m. live on Right Side Live as I continue this discussion. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.